Hello everyone, my name is Shane Van Dalsum. I've been asked by Dr. Connor to put together a short presentation on poverty and financial literacy. To tell you a little bit about myself, I have been a finance professor at Washburn for about 5 years now. Prior to that, I was a finance professor at University of Wisconsin at La Crosse. For the 6 years before that, I was getting my master's and PhD, and before that I worked for about 4 years between my undergraduate degree and my MBA, primarily as a commercial credit analyst and a commercial loan officer for Bank of America and then for Arvest Bank there in Missouri. During that time, I also worked with a lot of individuals at the bank and have advised people in poverty on their finances and worked on 2 different financial literacy campaigns for the universities that I've also worked at. So Dr. Connor asked me to go through some myths that people believe about poverty and financial literacy, and then to answer some questions that she had posed to me. The first myth I'm going to cover is that people in poverty don't know how to manage their money. And in my experience, that isn't really true. One thing I want you to know is that poverty is generally defined based on a household's income. So here in the United States in 2020, the poverty level for one individual is $12,760. And for a family of 4, it's $26,200. So we define poverty in the United States based on annual income and not the amount of wealth that someone has. Wealth is not income, but is often the result of having income and managing income well. And whenever people have income and manage it well, they're able to accumulate assets and money, and that is what wealth is. Some people don't know how to manage their money. However, poverty often comes from a lack of opportunities and resources, not a lack of being able to manage money. And I've included an article along with this presentation that's entitled "Poor People Are Already Financially Literate, They Just Need More Money." And the point of that article is to say that people who live in poverty often know their money very well. And that's been my experience when I've worked with folks that are struggling with poverty, is that they know where their money comes from, they know where it goes to, they know it very well because they have to, because small emergencies or unplanned for expenses can really wreck their lives. And so I encourage you to read that article to get the perspective of someone who grew up poor and their experiences with poverty and how they saw the world. And then as they got older, they were able to gain wealth and gain income and get out of poverty. The second myth is that high-income individuals are good at managing money. I actually saw a lot of this at when I worked for a bank. We had several doctors, mainly doctors, some lawyers, a few politicians who generated pretty high income. The politicians did it from the businesses that they owned, but in general, we're not very good at managing their money. So having a high income doesn't always correlate with having wealth. Again, wealth is the accumulation of income. Professionals outside of financial industries often don't understand how to save and invest and have other priorities. So there's a good article that I've included with this presentation that's entitled "Teaching Financial Literacy to Young Doctors." And really, I saw a lot of this. Young doctors come out of school, they have a lot of debt, they have a lot of medical debt. Lenders see them as people who can afford expensive things, nice cars, nice houses, and so they're willing to lend them even more money. And young doctors can oftentimes get into a lot of problems financially because they haven't really sat down and as talked about in the article, they haven't really sat down and looked at where their money's going to and how they're going to have to generate a lot of income in order to pay off their loans and pay for all the new things that they want to buy. I have a friend who is a successful doctor, an internal medicine doctor, and on a board of directors of a very large hospital. And a few years back, he actually decided to sell his home because he had a home that cost about $500,000. And he said he's spending so much of his time working for that house that he couldn't really afford to do other things, and he really saw that that large house and the debt on it as a significant burden to his life. And so he said, I'm just going to sell my house. And then he and his family moved into a much more modest house, and really kind of changed the way he worked and how he viewed life and his ability to spend time with his family. So the idea that people that have high incomes are good at managing money isn't necessarily true. They're usually good at something, but it's not always managing money. The third myth, financial decision making is as simple as knowing the math. So this is certainly not true. There's a lot of good websites you can go to, financial websites that you can go to, that will do the math for you. I'm going to give you a few of those websites later on. Really, financial decision making, the hard part of it, comes down to understanding your options and your personal values and how you budget your money in order to really kind of fulfill your needs and your wants as much as possible in line with your personal values. I put a quote down here, show me your budget and I'll tell you what you value. And I've heard this quote a lot. I've said it a lot because, a person might tell you that they value education or that they value relationships. But if you look at their budget, you may not see that there, that you may not see where they're spending money on education or not spending money so they can spend more time being educated. They might spend their money in foolish ways or in kind of trivial ways that take away from their ability to focus on the things that they say that are important. The next myth is that people are poor because they choose not to work. So again, this is something that I've experienced. I've noticed that it's really not true in many cases. I've included an article here that says most working age SNAP participants work, but often in unstable jobs. And what SNAP is the Supplemental Nutritional Assistance Program, and it's a program designed to help people that have low incomes and may not be able to afford healthy food based on the incomes that they have. When I was young, my parents got divorced when I was about 3 or 4 years old. My mom was raising 2 kids on her own for a lot of that time until we became adults. And for a lot of that time, my sister and I were on reduced cost lunch programs because my mom didn't have a college degree. For a lot of that, she worked a part-time job in the evenings in order to make money. So those free and reduced lunch programs at schools are part of the SNAP program. The article that I've included talks about the idea that working age people that use SNAP often do have jobs, or they're continually shifting between different jobs and are using those SNAP benefits to fill in between those jobs, or just have low incomes because of the job opportunities that they have aren't very good, and they don't have very high incomes as a result of that. So I encourage you to read that. To me, it was really eye-opening to see that for a lot of people, sources of income are not consistent and can be really unreliable and unstable. And as a result, they need to use these programs to fill in the gaps. The other thing I wanted to point out, and I'm recording this on March 21st, and so the unemployment rate is likely to go up quite a bit in the near future. But the current unemployment rate prior to the coronavirus pandemic was 3.5% of the United States. And so there aren't very many people in the workforce, those who are eligible to work, that are unemployed, that are out there and not working. And so, again, we still have a lot of people in poverty, but we have a very low unemployment rate. So the idea that people are poor because they don't work or choose not to work simply isn't true. Dr. Connor gave me a list of questions she asked me to answer for you all. So the first question says, what challenges or roadblocks have you found to be common for low-income families trying to manage their resources? The number one problem I've seen is that being poor is expensive. You may not think about that, but having some amount of wealth and some amount of income, a decent amount of income, really reduces costs. So the first thing I want to talk about is being unbanked. Poverty and not having a checking or savings account often go together. Part of this is because if you're poor, you're more likely to have bounced checks or insufficient funds. And if you leave a bank relationship and there's still money due on a checking account where maybe the person has written a check and didn't have enough money for it, and so the bank still shows that they owe money, that person won't be able to go to another bank and open an account. So if they can't afford to cover the checks that the bank has covered for them through overdrafts, or they've had insufficient fund checks, the ones that just kind of bounce, they won't oftentimes be able to open checking accounts at other places because the banks have a system to check when someone tries to open a checking account. So a lot of people just go unbanked. As a result, the fees to access cash and fees to convert cash to money orders are high. Oftentimes, there are fees to access or to cash your paycheck. And so those fees can add up quite a bit and make it expensive. When I worked for Bank of America, we actually produced a card for employers that if their employees were unbanked, they could load their paychecks onto these kind of like debit cards. And the way to access that their employees would access those cards would then be to go to a Bank of America ATM, put the card in. Even though they didn't have an account with Bank of America, their paycheck was loaded onto that card and they could withdraw money. The problem was that they also got charged a fee by Bank of America to do that. So there's fees associated and costs associated with being unbanked. There's also the high cost of borrowing. When you're poor, one of the main ways that banks base how much they'll lend you, or other types of lenders will base how much they'll lend you, is on your income. And when you have a low income, you're riskier for those lenders, and so you're going to pay a higher interest rate. I put on here payday lenders. These are organizations and companies that will lend you money based on your expected paycheck for that week or for that 2-week period, and they charge extremely high interest rates. There's also ones that are called title lenders. So if you own a car, you can go, and if you have the title to that car with no liens on it, you can go to a title lender. They'll take the title of your car and they'll lend you money. I've seen the loans from these places. I've had borrowers come into me when I worked for the bank trying to refinance these loans. And what I remember specifically through a title lender was that it charged 300% interest annually. They're supposed to be short-term loans, but the interest rates on them are extraordinarily high, and a lot of people get trapped into those loans because they can't ever pay it off. And so that really high interest rate just keeps coming in, and they have to pay more and more in order to pay that off or get that paid down. Another problem associated with being poor and the expense of it is higher food cost. You may have heard of food deserts. We often see food deserts where there's a lot of poverty. So food deserts exist whenever people don't have ready access near to where they live or near to where they work to good food, nutritious food. And so it's difficult for that live in poverty to often get transportation to and from good grocery stores and good places to find food that are inexpensive, and not going to the local convenience store where the food isn't very good for you and it's very expensive. Also, there's oftentimes a lack of storage. So here at my house, we've got a refrigerator, we've got a freezer out in the garage, we have plenty of storage for food, we've got a pantry. But if you're poor and maybe you're living in a small apartment, or maybe you're sharing space with a lot of other people, you may not have access to that storage area, and so you may have to kind of live on expensive, convenient food, and also have to eat out a lot as a result of having that lack of storage. A really big one, and I'm going to talk about this one more later, is higher and uncertain transportation cost. So here in Kansas, we don't have very good public transportation. A lot of times, and even with students at the university, this comes up quite a bit, where they don't have much money. They drive, vehicles that certainly aren't new and oftentimes in bad shape, and their cars break down. They might get a flat tire, they might have problems with their engine, oil leaks, and so on. And so as a result, their cost of transportation on a daily basis are just higher because they're driving an old car. It's fuel inefficient. It breaks down a lot. And the other key part of this is that it's uncertain. So for example, I drive a car that's about 5 years old. I got an extended warranty on it. I don't have to worry about it breaking down because I can just take it to the dealer and get it fixed. It's got great gas mileage. And so my daily transportation costs are actually pretty low because my car's newer. It's not having any problems. It's fuel efficient. But if you are having problems with an older car, you might have a very expensive repair come up you may not be ready for. The next one is higher medical cost. So oftentimes people that are in poverty either have no insurance or kind of poor health insurance that doesn't cover a whole lot or has very high deductibles. So oftentimes people, when they live in poverty, when they get sick, will go to an emergency room rather than going to a doctor earlier on for preventative care. The lack of insurance, again, can increase the cost. So this past summer, my son had a few surgeries in New York. We found out afterwards that one of the doctors that performed part of the surgery was not covered by our health insurance. And we received a bill, and this was for one doctor and his team. And there were, I think, 4 different teams that worked on my son. One doctor for his team. The bill from that doctor was $98,800. Okay. So we couldn't afford that. And, eventually it all got worked out between the hospital and the insurance company, but it was very stressful for us. When the insurance company came around and they worked it all out and they figured out who owed what, it turns out the insurance company really did have to pay that. And so what the insurance company paid, though, was not $98,800. They were able to negotiate the bill down to $30,000. And so oftentimes insurance companies have negotiated deals with healthcare providers where they pay much less than you would pay on your own without health insurance. So that lack of insurance can really increase cost, not just because someone doesn't have insurance, but because they also don't have the ability to negotiate with the healthcare provider. And the last part of that is the lack of preventative care. If you have health insurance, it does cover in the United States preventative visits. And in those cases, you can actually talk to the doctor and get solutions for problems that may not have gotten serious yet. And that's going to save money in the long run. So you're not having to go to the ER and having to have expensive medical treatments to fix a problem that has emerged over time. So the general theme to answer this question is that a lack of money results in an inability to implement long-term plans. Because if you're paying all of these fees and costs associated with being poor, you're not able to put back money to implement a long-term plan, such as putting together an emergency fund. And that's what I put down here. Having an emergency fund is critical. The biggest issue that I've seen is that low-income families can't afford reliable transportation. Oftentimes then we have emergent problems, and I mentioned this before with vehicles breaking down. And why this is so critical is then if you've got a broken down vehicle and you don't have adequate transportation or reliable transportation, it's going to hurt your ability to keep a job. It's going to hurt your ability to get to school and do those things that you need to do to provide for your future. I've included an article that goes along with this question called "It's Expensive to Be Poor," and it covers several of the items that I've mentioned here in a little more detail. The next question says, what are the most common thinking errors people have when approaching money management? So the most common thinking errors that people have when approaching money management is that they often miss that our relationships have a strong impact on how we manage our money. And so whenever they go to making some financial decisions and make some changes in their life and how they approach things, it can be very difficult because suddenly their choices with their money are going to impact their relationships with others, including a significant other, a boyfriend, a girlfriend, other friends, other family members, because oftentimes we spend money in our relationships, buying people's gifts, going out to dinner with people, going on trips with people. And sometimes when we look at how we spend our money and manage our money, pulling back on those things can really hurt people's feelings. If your spouse is used to you bringing home flowers, twice a week and going out to dinner 2 or 3 times a week, and you start to pull back on that, they might see that as you pulling back from them. And so oftentimes there is a lot of stress, especially in relationships, over money management. In fact, here in the U.S., we know that the number one cause of divorce is financial difficulties. So when we change our finances, we're going to impact our relationships in our lives. The second one, and this one's kind of controversial. People often believe that debt is inherently bad. Some debt is bad. Some types of debt are bad. If you're going into debt on your credit cards to pay for things that aren't needs, so you're going into debt on your credit cards to go out to eat, to buy new clothes, unless they're needed for a job, to just have fun, and then that's bad. So what I mean by going into debt on credit cards, if you're using a credit card and paying it off every month, you're not going into debt on the credit card. You're using it as a convenience tool. And really, credit cards can be used as a safety tool too, because when you use a debit card, you're actually giving someone access to your checking account. And I've had this happen where my wife's debit card number got stolen and they wiped out her checking account. With a credit card, you have some protection there. You also have, by the way, some protection with a debit card, but it's more inconvenient to take care of that issue. With a credit card, you have protections in place where you're only liable up to $50 if someone has stolen your number, and you report it in a timely manner. I've also had the situation where someone has gotten my credit card number, and the credit card company will often know before I do. And so they'll contact me and they'll say, look, we don't think you're down in Texas today doing this stuff. Are you? Are these charges legit? And in that last case, it was probably 3 months ago, I texted them back and said no, and they shut off my credit card. Other types of debt that aren't inherently bad. Mortgage loans. So, you can choose to rent or to buy a house or to buy a condominium or something like that. There are pluses and minuses to renting versus buying. But in the case of buying a house, if you're in the position to do that and it makes sense for you, that debt is going to allow you to build equity and to build value into your home. I don't want you to think, though, that houses that you live in for the purpose of living in them are a good investment. They're okay, but if you're looking for an investment, that's not the best thing to do. But it does allow you to gain equity and to gain value into the place you live, and also gives you some ownership rights and the ability to adjust where you live, change your surroundings some to make it more comfortable for you. School loans. We hear a lot about school loans today. So by and large, the issue with school loans is not whenever a student goes to school, takes out school loans to pay for their classes, to pay for tuition and books, and then graduates in 4 years with a job where they can pay back those school loans. That's hopefully the norm. That's not where people get into trouble. The number one issue with school loans today is people taking out school loans and not finishing their degrees. That's where we see defaults, especially if people are going to for-profit private schools. The tuitions there tend to be very high, and the success rates of those students tend to be very low whenever they graduate from college. And that's really where we see problems with people going into default and having really big student loans. But if you're taking out student loans to improve your income, to get a degree, to provide for yourself a more secure future, and you're doing it smartly by only taking out and using what you need, school loans can be a great thing. I brought myself and my family now out of poverty, and I took out several loans in order to do that. But my income increased dramatically because of my graduate school education. The last part of this, people often believe that habits can be easily changed in order to save money, and this kind of goes along with the first part. So we might say, okay, I'm going to stop eating out in order to save money, but if you don't know how to cook, that might be a difficult thing to just change very easily. You might say, I'm going to cut back on a certain habit or a certain hobby that I have, but you might find, and oftentimes we find that people have a difficult time doing that. So think about the things you're going to change when you think about financial literacy, or when you're talking to people about financial literacy, and how difficult it will be for that person to make those habit changes. A few years back, my wife and I were talking with a local church here in Topeka, and one thing that they did for the part of our population that live in poverty is that they provided some financial literacy training and financial management techniques, and they would help them budget. And one thing that we were told that really surprised us was that if someone takes drugs and is addicted to drugs, they say you need to include that in your budget, because otherwise your budget's not going to be realistic. I mean, we hope they stop taking drugs, we hope they get help with their addiction, but on that day we're there to help them make a financial plan and how to budget their money. And if that's a habit that they need to do, then we're going to go ahead and include it. So that's something to really consider when you think about financial literacy and financial planning. The next question was, what would you say are the 3 most important money management skills for a person to have? So the first one is delayed gratification. If you can put off buying things that you don't need, you're going to be able to accumulate things like an emergency fund and accumulate some money where you're going to be able to have more reliable transportation. You're going to be able to, have a checking and savings account. You're going to be able to kind of fill in those needs in your life and really smooth things out and make life a little less difficult. And then I put on here, avoid FOMO, the fear of missing out. Just a rule of thumb is, if you're looking at something that you want but don't need, wait 3 days. Don't act on an impulse. Wait 3 days and see if you still want it. And then if you still want it, if you still think this is something I'd really like to have, then start to consider how you're going to pay for it. But oftentimes that desire to buy something that happens in a moment goes away over a little bit of time. The next item is be able to recognize wants versus needs. And again, sometimes whenever people say this, they're saying that people misidentify things as needs when they're really wants. But sometimes it's the other way. Sometimes it's that you think something is just a want, but it's really a need. So for example, we're under quarantine in my house because we've got some folks here in our house that have compromised immune systems. So none of us are really going out anywhere. I find I need to go to the gym, although I can't really do it right now. That's not really a want. It's not something that I could easily just take out of my budget, especially since it's kind of cold outside right now. And so sometimes you have things that you might identify as a want, and they're really a need. And so you have to identify that and really know that whenever you go to make a budget, or you're helping someone else make a budget. And sometimes you really do have things that are, you would classify as a need, but are really a want. So the ability to really clarify that is important when you're thinking about building budgets and understanding your finances. The last item I have for this is having the ability to focus on different time horizons and build a plan to get where you want to be. So I see this a lot with young people, people just graduating with their bachelor's degree, because we're looking at folks in their early 20s and saying, now you need to start thinking about your retirement in 40 some years. It's difficult to do. It's difficult to see that far in the future and really start making plans. Although the earlier you can start, the better off you're going to be at the end. Oftentimes when people graduate from college, they're looking at getting a new car, they're looking at getting a house, they're looking at going on vacation, and all that's fine if you can afford it. But being able to focus on the different time horizons and setting up plans for those different horizons is important. Even in people that are living in poverty, you want to make sure they take care of those needs: housing, food, clothing. Make sure they're getting everything that they need. But then they also need to be able to focus on longer term goals: getting reliable transportation, getting an emergency fund set up. So if something does come up, they're not going to be broke. And then start building on to what are they going to do when they can no longer work. The next question says, what resources are available to low-income families that they might not know about automatically? So legal aid is one that I'm not all that familiar with, but I know that it's around, and I know that for a lot of people living in poverty, this can be helpful, especially if they're having problems with people like landlords, or maybe they got ripped off from a car dealer or something like that. But having legal aid available that is affordable is important, and I've provided a link here to Kansas Legal Services, where if you're helping someone, or if you need some help with legal services and you can't afford a regular lawyer, they can work with you and help you out with that. I've got to also advertise the VITA program. The VITA program is a free tax preparation program where you can meet with people that are trained to help you complete taxes, because it's put on here locally by Washburn, and folks in our accounting department help out with that, and we're really proud of that. The next programs and resources that I want to tell you about is Medicaid and CHIP, and CHIP stands for Children's Health Insurance Program, and that is actually put out by the Medicaid program here in the U.S. Medicaid is a form of medical plan or medical insurance for people who live in poverty, and the CHIP program is specifically for children. And what people, so most people do, they know what Medicaid is, but what they don't know is, especially with the CHIP program, the guidelines are actually pretty broad there, and that they're going to cover a lot of children that you might not think would have access because of their parents' income. But oftentimes there's other situations involved there where, the child has a condition that is long-term and very expensive. And in those cases, even if the family may not be under that poverty guideline, they still will qualify for that CHIP program. And then sometimes you have people who don't realize that they qualify for Medicaid. So when I was getting my doctoral degree, my wife and I decided it was also a good time to have kids. Certainly not good on our good for stress, but kind of where we were in life and our ages, probably a good plan for that. And so when my son was born, my wife had to stop working. She had some medical issues come up during that pregnancy, and so she had to quit her job early. So based on the cost of childcare and our expected time to stay there in Arkansas, my wife decided, and I agreed with her, that she should stay home from work because it wouldn't have made much financial sense for us to have her go back to work. And so when we were at the hospital, the social worker for the hospital actually came to us. We didn't bring it up with them because I had already secured insurance for my son. But the social worker came to us and said, and talked about our situation. My wife's not working. I'm in graduate school. That was my only income. I had an assistantship through them. And we also had kind of okay insurance through the university. She actually came to us and said, look, you qualify for Medicaid. Well, not my wife and I, but your children do. So my son was put on Medicaid, and then my daughter was born about 13 months later. Not good, again, not good for stress, having two toddlers / infants in a small apartment where you're getting your doctoral degree, but it worked out in the end. And they were qualified for Medicaid, which surprised us a little bit because I did have access to insurance for them, and we had made plans to pay for that. But something good to know, especially if you are working with folks that have children that have a lot of medical needs, they should check out this program, the CHIP program, because even if they're not classified as living under the poverty line or even near the poverty line, they will oftentimes still have access to the CHIP program even if they already have insurance. So sometimes these programs step in where your regular insurance will not cover things, or maybe you'll have a high deductible or high other costs, and these programs will actually step in and help meet those needs. The last thing I have on here is, I've come across situations where there are little less well-known sources of income or discounts or ways to make things that are affordable. So some things that I put on here that I've just experienced in my life: YMCA scholarships. When I was young, we didn't have much money. I was able to get, and everyone in my household was able to get greatly discounted YMCA scholarships. Pharmaceuticals. So I would not be classified as low income or even near poverty at this time. And yet, because of health problems that my wife and my children have regarding arthritis, we're able to get low cost pharmaceuticals through those companies that manufacture them, because those companies are required to have these plans in place, and we've worked through a pharmacy and our insurance company to get low-cost pharmaceuticals that would be prohibitively expensive if we weren't able to do that. So check with, if you're taking medications that are, especially if they're non-generic, or you're working with someone that are on expensive medications, check with the company. They'll usually, on their website, they'll have a number that you can call. They're required to now on their advertisements include information on how to contact them to get a lower cost. So that can be a big money-saving move for someone who needs that. Also check with local churches. You don't necessarily need to be a member of a church or even going to a church in order to receive benefits from them. So for example, the church that I attend, we have a closet for people to come in and get clothing and things that they need, but it's not advertised. So you might go to, the local church and say, I have these needs, or I know someone who needs clothing, who needs food. They're going to, if they don't have something there at the church for you, they'll often be able to point you in a good direction to go to get those needs met. So that covers that questions and really the questions that Dr. Connor asked me. I wanted to include one last thing. There's one last thing I want to talk about too, and because it's so important and it's something that a lot of people miss. So credit scores are incredibly important, especially when you're young, when you're thinking about your future. A low credit score can result in missed employment opportunities, high insurance costs, higher interest on loans, and a reduced ability to find livable housing. A couple of years ago, I was talking to a local bank professional, and she told me that the biggest problem the bank has with hiring students from Washburn is that they have low credit scores. And not every student at Washburn has low credit scores, but in general, this was the problem that they had. Banks can't hire people who have poor credit because the folks that they're hiring are dealing with other people's money all the time. And so if you can't manage your money well, it's a risk that you're going to get in there and try to make up some of your money problems, handle your money problems by taking other people's money. I've seen this when I worked at a bank. We caught a teller who was pulling cash out of companies' bags, cash bags that they bring in. And so as a result, if you have bad credit, a lot of times employers, other than banks even, won't look at you as a viable candidate, because oftentimes that's a red flag to an employer that you won't handle that employer's money or your customer's money or your customer's needs well. And so oftentimes that'll take you out of a pool of viable candidates just by having a low credit score. It increases insurance cost, homeowners insurance, car insurance, renter's insurance. Again, insurance companies will look at your credit and they will use that as a guide to determine whether or not you'll have the ability to get insurance through them and what your insurance costs will be. Because as they take on more risk, they're going to charge more for insurance. Higher interest on loans, that one's kind of obvious. If you don't manage your money well and you haven't handled credit well in the past, then the bank's going to have you pay more on interest if they're willing to give you a loan. And finally, a reduced ability to find livable housing. So in a renting situation, that landlord is probably going to pull a potential tenant's credit report and credit score to see if they've done a good job in the past of paying their bills on time, managing their money well, because that landlord is counting on that renter to pay their rent on time. And so if someone's demonstrated that they're not able to do that well, that they're not able to manage their money well, then if that landlord has other options of people to rent to that are more likely to pay on time, they're going to rent to those people instead of the folks with the bad credit. So if you're talking to someone about their financial situation and they're having a difficult time with these things, one thing that you can help them do is to help them improve their credit score. I put in 2 articles associated with this. The first one says how are FICO scores calculated. It goes through how those scores are calculated. It's changed a little bit recently. And then the other article is what is a FICO score. So FICO is a brand name. It stands for Fair Isaac Corporation. I've talked with them before and worked with them a little bit in the past. They are the originators of the FICO score and really the original credit score. Now there's other places that calculate credit scores. They generally tend to be in line with Fair Isaac Corporation and how they do it. And really, their goal through calculating that credit score is to give a reliable measure to lenders, employers, insurance companies on people's level of risk. The one thing I don't have up here on the screen that you may want to check out is a website called annualcreditreport.com. It is a site where you can pull up your own credit report from 3 different credit reporting agencies once per year for free. So you might, or if you're working with someone else, have them pull up their credit report. That credit report isn't actually going to show them their score, but it's going to show them everything that's outstanding, if they're up to date on their payments, and anything that might be hurting their credit. Credit scores are actually available now through a lot of different websites. Credit Karma, I think, has them. A lot of credit card companies will tell you your credit score just whenever you want to see it. So credit scores are widely available, but I do encourage people to go to the annualcreditreport.com and pull up their credit reports to see anything that's out there that shouldn't be out there. So someone's maybe taken out credit in your name and you don't know about it, or to see if there's anything out there that they can fix on their credit to improve that credit score. So that's it for my presentation. I really appreciate the opportunity to talk to you about this. It's something I'm passionate about. If you have any questions that I can answer, I could go into more detail about any of these things that I've talked to you about in this presentation, please let me know. I'm here at Washburn University. My name is Shane Van Dulsum. Feel free to email me, call my office, and I'm happy to talk with you about this. Thank you.